All right, we should be recording. And let me see if I can share my screen. Apollonia, can you tell me, do you see the exercises in front of you? Do you have your computer on? No. Okay, let's try this one more time. Now do you see it? All right, good. Thank you for letting me know. Okay, so let's just jump right into this chapter. It's a pretty easy chapter. It's on budgeting. It's a really important chapter. So we'll look at all kinds of different budgets. You'll start to see there gets to be kind of a pattern in these budgets, but this first one is a unique one. This is a personal budget, and it just says here at the beginning of the school year, this student decided to prepare a cash budget for the months of September, October, November, December, so fall. The budget must plan for enough cash on December 31st to pay the spring semester tuition, which is the same as the fall tuition. And then they talked about these different things. So they started off with $9,200 in their cash account. They purchased some football tickets. That's a one-time thing. Additional entertainment each month, $250. What the semester tuition is in the fall, it's $4,800. So what they're saying is we got to have $4,800 at December 31st to pay for spring. And then there's some rent every month. Appears as if Craig likes to eat a lot. There's $550 of food. There's a deposit, and then they do get that deposit back, so that's nice to know. And then the earnings. It just says prepare a cash budget. And I guess the key that I want to make sure you all hear is the formatting of a lot of these budgets, and that's managerial accounting. We don't need to be so fussy about that. As long as we have everything included, you may have it laid out differently, but as long as we get down to the same answer or the same bottom line, that's fine. We don't have to have these look the same. So how they did it here is they just laid it out, these columns, September through December. And here again, what was the job earnings every month? $1,200. So they got the revenue up on top, and kind of like your P&L, all the expenses here on the bottom. So in September was that one-time payment of football tickets. Entertainment every month, it said, for $250. In September, they paid the tuition, pays rent every month, pays for food every month. And then there's that one-time deposit that they had to put down, $660. So we got what we got for money coming in, for money going out. Well, and of course, in the month of September, it's going to be a gigantic money going out. However, we started with $9,250. So some of you may put the $9,250 up here. You started with that. Here's all what you've got. And then you have your end of the month, okay? So then you say, okay, this is all the revenue that they had for October, all the expenses they had for October. Again, it was a deficit, but we had $3,490 from September that we're going to carry over into October. So again, it just whittles our account down a little bit, right? And then in November, again, we're short again $200. It used up $200 of our cash balance. We still had $3,290 in the bank, so now we're down another $200 to $3,090. But in December, there's one thing that's different. Remember this deposit here of $600? We get that back in December. So here's another $600. So our cash receipts is $1,800. Still the same $1,400 a month cash outflow, but this month we ended up in the black of $400. So taking what we ended in November 30th to December 1st, 3090. We're going to end the month, or excuse me, end the fall at December 31st of 3490. Now, if you look up here in September, we need $4,800 for January 1st's tuition payment. So of course, we didn't get there, and it says it too here, this difference of 4,800 and the 3490. We were short 1310. So that at least gives you information to say, okay, what do we got to do? We either got to put a few more hours into our part-time job to increase this total up here by $1,300, or eat less. The rent, obviously can't change that. Looking at entertainment, right here, 250 times 4, there's $1,000, but it's probably not realistic to make that be zero. So those are the things that the budget tells you, and all of us in one way, shape, or form work with a budget, and especially most college students know what they have for money coming in each month, but they also know what it takes to live every month. Any questions on number 1? Okay. Number 2 is what they call, and it talks about it in the text, the flexible budget. And what that means is it will flex based upon volume. And if you look at number 2 here, it says Digital Solutions uses flexible budgets that are based on the following data. So they got sales commission, advertising. So those are completely variable, right? But then you see miscellaneous, administrative, office salaries. Miscellaneous for certain. Notice that that's $10,000 per month plus 4%. So that's what we learned in the last unit. Mixed, right? That's a mixed variable and fixed component. So 10,000 is fixed, and then you got your variable component. Office salaries fixed. Customer support, there's that mixed component again, and then you got fixed. Again, you could set this up many different ways and still get to the same answer as long as you just know what you're doing. But what they did in this layout is they put the volume up on top, the sales volume. It says prepare a flexible selling and administrative budget for sales volume based on 500,000, $750,000, and $1 million. So here's the volume. And what they did here is they put all the variable costs on top and the fixed costs on the bottom. You don't have to do it that way, and you can still get the same answer, but that's how they split it. They put all the variable on top. So sales commission, that was certainly only variable. So based on 500,000 at 8%, 40 grand, 8% of 750, 60 grand. Advertising, same thing. Then you see the miscellaneous administrative, that's at 4% of sales. 4% all the way across, but then there's also the fixed component, 10, 10, 10. And then there was the office salaries, 50, 50, 50 all the way across. Customer support, that was 30%. It's a big number, as well as a fixed of 20 all the way across the board. Research and development was only fixed, 75. So in this problem, they're just trying to show you that their fixed cost per month is $155,000, no matter what the volume is. Based on the volume for all of our variable costs, as you might expect, in total, those dollars are going to change significantly. So when we add up the variable and the fixed, we can see what our total selling and administrative expense budget is. So what are they trying to teach us in this problem? Of course, like we learned in the last unit, some costs are variable and some costs are fixed. Anyone have question over number 2? All right. Number 5 is a production budget, and I was scrolling through here and I realized I don't have a copy of number 5 in here, but it is just exactly like number 6, part B. So let's read 5 and then we'll explain it. So this company produces bath and gym version of its popular electronic scale. The anticipated unit sales for the scales by region are as follows. So they tell you the northern and the southern region, and then the 2 different types of scales. Okay, it says here, the finished goods inventory estimated for March 1st for the bath and gym is 11.8 and 8,100. Then they tell you what they want to have in ending inventory. And the whole point of that is this. When we get down to the end of the month, there is going to have to be ending inventory, right? We don't end the month with everything being sold, and then when the calendar turns, we gotta produce like crazy so that we can have sales and have inventory to support those sales. So we know as we're going down the month that there's orders put in, and we know that there's always we're gonna tell the customer there's a lead time, it'll put in your order, it'll take a week. So we always kind of have that understanding of, okay, this is how much we need, and we can kind of see that number grow or decrease. And that by itself will tell us what do we need to produce so that when we do flip the calendar and there's an order, that we have inventory. But at the same time, we don't want to produce so much inventory that now it sits, and some inventory, it depends. It could be obsolete. Some of it can rot. If it's a car, it stays fine, but we don't want to have so much money stuck into our inventory if we're not moving it. So they tell us how many sales they're going to be. Okay, in this problem, how much is there for sales? Well, in this case, in this part here, part B, it looks at rumblers and thunder. In problem number 5, it would be, here's the bath scale, and this is the gym scale. So how many do they expect to sell? Well, the truth of the matter is we don't really care about the region. We just need to know how many bath scales. Right up here, $115,000. How much inventory do we want to have at the end of the month? Well, at the end of the month, it said 15,000. So if we're going to sell 115,000, we want to have 15,000 of ending inventory. That will tell us what we need to have available or what we need to produce. Okay, and then this estimated inventory at the beginning would tell us, in this case, it is 11,800. So we already have 11,800 to start the month, so we can take that away. So we know how much we're going to sell. We know how much we want to have at the end. We can take away what we're going to begin with because we don't have to reproduce those. That tells us the total number of units to be produced. Okay, so again, in this problem, the numbers would flow like this. 115,000 would be your first one, and I'm just going to give you the numbers here with my calculator. 115,000 we want to produce, or excuse me, we want to have for ending inventory of 15,000, so plus 15. And we will take away the 11,800 that we started off with. So for the bath scale, our total units to be produced would be 118,200, 118,200. And that would be the exact same format for the gym scale. Going to number 6, it's the same thing again. They want you to do a production budget, but also a sales budget. Well, in this problem here, and again, I believe it very, very much, you can set this up all different kinds of ways. Ultimately, what is the big takeaway? We got to get to this number right here, 2.2 million. So again, they're telling you the type of item they're selling, the product, and then the region. So there was two types of models, the Rumble and the Thunder, and then they also tell you the region. Again, it really doesn't matter. We have 26,000 units of the Rumble that we're selling at $60. We have 7,500 units of the Thunder at $90. The summation of all of that is 2.235 million. That's what we need to know. That's the sales budget. Sales budget is the easiest. You just need to know the selling price, the volume, and you got a calculator and you're done. One other thing that you should write down, because I know every year I use this as a multiple choice question. What is the first budget you should start with? When you got all these different budgets, production budget, sales budget, labor budget, selling and administrative budget, overhead budget, all of them. Well, truth be told, we start with the sales budget because based on sales, the units, the volume is what's going to drive production. It's going to drive how much labor we need. It's going to drive how much administrative expense we may have, selling expense, overhead, all of that. So what's the budget we start with? Sales. Sales is the first budget. Again, here's our production budget, and it's the same format every time. What are we going to sell? Plus. What are we going to end with? Minus what we started with. And then that's the units to be produced. So expected units to be sold, well, they got it right here. This is from the sales budget. So sales gets us right into production. 7,500 we're producing right here. That's what how many are we selling? 7,500 units. We are going to put that in the production budget. So we know right from the get-go, we're going to have to at least have 26,000 Rumble units on hand in order to meet the demand for that sales. And we're looking at our production budget. Interestingly enough, we only need to produce 250 units less than the 26,000 we needed because we began our month of June with a bunch on hand. So that helps lessen our load. So if you know there's a month coming up that you're going to have high demand, perfect example. We're in November, but we know Christmas is happening in December. So we will up our production significantly in the months of, possibly September, October, November, so that we are geared up and ready for the demand of December. So before we move on, anybody have questions over 5 and 6, the sales and the production budget? Okay, you bet, very good. Move on to number 8. Here's a labor budget. And again, based on production is going to tell us how much labor we're going to have. When I was the CFO at that company in Canton where we built the coolant compartment of the engine for John Deere tractors or BMWs, we had constant communication with their end of their company, so we know, okay, well, they got, of course, when does John Deere have their busy seasons? Planting and harvest, right? And it would be different kinds of components for whether it's fall season harvesting or the planting season. So, of course, knowing that and what their estimated needs were, and they never would sell out of everything. They'd always want to make sure they had inventory in hand. That gave us an idea of what was the demand and what did we have to produce. But then ultimately, that flowed all the way down to how many people do we need? And it gave HR an understanding of, well, do we need to do a huge recruiting? Or, and we were at capacity, we couldn't physically put we couldn't put any more bodies onto the production floor because we were full. Well, then our alternative was, at that time we were running 2 shifts. I think here a minute, 6 to 2:30, and then it was 2:30 to I want to say 11, I believe is how that worked, from 6 to 2:30, 2:30 to 11. Well, we still had so much production that had to happen. We had no more physical space to put people. We were not going to add on to the facility, not knowing that this was going to, sustain for much longer. So we added the third shift, which went from, 11 p.m. to 6 in the morning. So we were running then 24 hours a day, 6 days a week to meet the demands, but you had to have labor. So in this problem number 8, what they're saying is, looking back at number 7, what is the average compensation per hour for staff and for the partners, knowing what's in number 7? Well, in number 7, what they did here is they split it on staff compensation and partner compensation. They looked at what were the total hours in all 3 areas, audit, tax, and SBA, and same for the partners, total hours. Then what they were compensated by per hour gave us the total labor budget. So nothing too confusing there, but needed to know hours, needed to know. So if you look at this tells you how many hours. Well, quickly you can say that's 70,000 hours. There is approximately 2,000 hours per person per working year. So, and that's having them work 50 weeks a year. And you probably get more than 2 weeks of 52 weeks in a year. So there's 2 weeks of vacation. They probably get 4 weeks. So now you're down to 48 weeks. So 48 weeks times, your 40 hours per week tells you how many bodies you would have. That's 1. So then you take that number into the 70,000 hours would tell you, well, look at here, we need so many people, we need so many partners. It gives you a good indication, are you properly staffed? Number 9 is, again, another type of budget. It's a purchases budget. And again, sales would tell us then, okay, how much we got to produce, but based on how much we got to produce, we might need some raw materials. Well, in this case, number 9, they build pizzas. And the 3 components to the pizza are dough, tomato, and cheese. And in this case, again, it's the kind of the same format. Notice here, what do we need for production? Or think about sales, how many are we selling? What do we want to have for ending inventory for dough, tomato, or cheese? And then what did we start with? Dough, tomato, and cheese. So it's that very same format that we have up here. What do we expect to sell? What do we have in ending inventory, or want to have an ending inventory? And what did we start with? So in this case, they break it out by the 2 different types of pizzas, because a 12-inch pizza versus a 16-inch pizza will require more or less dough, tomato, or cheese. Well, let's just go down the row here. Dough for the 12-inch pizzas, it takes, in this case, there's 55, a little bit more than a half a pound of dough. So if you look at number 9, it says we are going to sell 70,000 12-inch pizzas. Well, 70,000 pizzas, it's not 1-to-1, so we need 0.55 pounds per for every pizza. So that would tell us we need 38,500 pounds of dough for the 12-inch pizza, 40,000 for the 16. For the 12-inch pizza, for tomatoes, it takes 0.25 pounds per pizza. Well, 70,000 pizzas at 25 or a quarter a pound, we need 17,500 pounds of tomatoes. And cheese, it takes 0.7 pounds per pizza. So in this case, we need 49,000 pounds of cheese for the 12-inch 12-inch pizza, 60,000 pounds for the 16-inch pizza. What we want to have for ending inventory tells what we got to produce, and then what we started with, so we don't have to recreate that. Then it takes us another step. It gets us to the dollars. We know we need to purchase $78,000 or 78,000 pounds of dough, but now the purchasing department or your finance department needs to know, oh my gosh, we better have $39,000 available just to purchase dough, $22,000 available to purchase tomato and cheese. So for the month of November, looking at our cash flow, looking at our cash needs, we need $154,000 or at least credit in order for us to do the 70,000 pizzas for 12-inch, and we have 50,000 16-inch pizzas. So this is just the cost of the raw materials that go into the pizza. And we're not talking about labor yet and all of that. So this is just for the month of November. Questions on number 9. So these budgets, of course, things change, right, all the time, but what it does is it keeps the entire company in sync. It keeps the entire company singing off the same piece of sheet music. So we all know what is needed for cash versus ultimately this is going to be a sales. So we always have to think of it this way. Okay, this is what we need in November, right? So hopefully the pizzas that we sold in October is going to produce us cash to help us cover the cash needs that we're going to have in November. Okay. Number 14 is a very straightforward, almost in a way, this doesn't sound good, almost in a way kind of a useless budget. All we're doing here is taking all of these overhead numbers and summarizing them on a sheet. And in this problem, what they're doing is they're separating it by variable overhead and fixed overhead. And they gave you 2 columns of numbers there. And what we're doing there is we're splitting up between variable and fixed, okay? Which costs are variable overhead costs and which ones are fixed. And that's all there is to an overhead budget. Questions on number 14. Number 17 and number 19 are very, very important. You can be assured companies do these 2 budgets, and this will be done in the business office, the finance office, the accounting department, and it's the schedule of collections from sales. Just because you're never going to have all your cash collected at once. And today, with everything being on credit, that cash flow is affected. Now, if you're paying by credit card, though you don't pay your credit card bill but once every 30 days, the credit card deposit to the company that you purchase something from, they get it every day. So even though you go to Target and you buy $100 worth of stuff, you swipe your credit card, you don't pay it for 30 days, but Target gets that $100 that day. So credit card is great, but if you say, and like for instance, Visa, who you used the credit card that you have, that's a 30-day lag before Visa gets their $100. So that's similar to this one in number 17. It tells you what are the sales, and then it says here, all sales are on account, all of them. So no credit card, they're all on account. 75% of the sales are expected to be collected in the month of the sale. So you sold it in January, you're going to get 75% of it in January. 20% the next month, and the remainder in the second month. So that's where they show here. The January sales were 300, and again, you can lay this problem out all different kinds of ways, but January sales, 75% is collected in January, 20% is collected in February, 5% in March. In February, 75% in February, 20% in March, and then there would have been another 5% in April, but this problem only wanted you to do January, February, and March. So February sales will go February, March, April. March's sales, of course, 75% in March, 20% in April, and 5% in May. So what it does here is it shows what would a normal cash flow look like? When are you going to get it? Well, this isn't a real good picture because this is only January's. You should always see three months worth of sales type in that month. So in March, you're going to get a little bit of January's, you're going to get a little bit of February's, and you're going to get a lot of Marches. In April, you would have seen the same thing where there would have been the three splits, 75, 20, and 5. Here's a question. Anybody answer it, please. What is the one thing, looking at this thing, you took 225 and we looked at accounts receivable. What's the one thing here they are not factoring? What are they missing? I mean, 75 plus 20 plus 5, that's 100%. What are they not factoring? Can anybody tell me? Bad debts, right? Everybody agree with that? They are expecting 100%, and maybe that's realistic, but maybe that's not realistic. If you are dealing with very few customers and it's the same ones every month and you know them very well, maybe 100% is accurate. But usually there has to be some type of bad debt calculation. And the other thing that we're not really ever thinking about, this is just an estimate that it flows this way: 75%, 20%, and 5%. That's not going to be exact, right? That's just an estimate. And then number 19 is on the payment side of things. So here is how we're going to collect our sales. This one is how we're going to pay our bills. So in number 19, it just says here, the projected selling and administrative expenses for the 3 months are March, April, and May, 52, 64, and 68. Okay, this one, please read along with me on this one. Depreciation, insurance, and property taxes represent 9,000 of those numbers above. All right, so now this is where it gets tricky. The annual insurance premium was paid on February 28. Property taxes in June. Okay, let's talk about that first. So there's the three things there: depreciation, insurance, and property taxes. First of all, depreciation. We need to take that number out of the 52,400 because depreciation is a non-cash expense. So we can look at our P&L, our budget of what we're going to estimate for depreciation for January, February, March, April, all the way to December. However, that will never use cash. So we got to add that back. That is an item that will not require cash or take it away. Okay, so the 52,400, our real cash expenditures is less 9,000 out of that, or 43,400. Okay, that makes sense. Now, insurance and property taxes. Remember in first semester, we talked about prepaids, prepaid insurance and prepaid property taxes. The insurance industry doesn't take insurance monthly. It's not like health insurance. They require 12 months upfront. Likewise with property taxes. The county doesn't let you make monthly payments, so you pay upfront. So what we have to remember here is it says the annual insurance premium was paid in February. The property taxes were paid in June. What's really nice about this problem is we're only looking at March, April, and May. So it doesn't look at February, and it doesn't look at June. So the point is, there was $9,000 worth of expenses that represented depreciation, insurance, and property taxes. So for our purpose, for March, April, and May, we can add those all back, the whole 9,000, because if it was whatever part of that 9,000 was depreciation, that would get added back for all 12 months, right? But for insurance and property taxes, how it would really work is like this, and I'm just going to use insurance for the example. So insurance, let's say the insurance premium was 12 grand, 12,000 bucks, okay? Well, there's 12 months in a year, that's 1,000 bucks per month expense, right? 1,000 every month. Well, this is how it would work. In January, you would add back 1,000 because that's not when we're paying it. In February, we would add back 1,000. Excuse me, the payment was made in February. Insurance, yes, insurance is in February. So in January, we'd add back 1,000. In February, we would actually have a cash outflow of 12 grand for insurance, right? 12 grand is going to get paid in February. In March, we don't have it again. So our expenses, even though our expenses are going to show 1,000 every month, because that's how we do with our budget. We show, because we take it out of prepaid insurance and we put it into insurance expense every month, 1,000, 1,000, 1,000, 1,000, 1,000. But when we're looking at cash needs, we didn't need any cash in January because we will pay it in February. Then in February, there's going to be a big check written for 12 grand. So it would be a huge minus of 12 grand. But in February, when we look at it according to the cash needs and look at all the expenses, we would add back that 1,000 because that expense listed in March isn't a cash need because we paid for it in February. Does anybody need that explained different or better? Please be honest, that's a tough concept. Are you saying thorough, or are you saying stop beating that dead horse? We got it. Move on already. Okay. So anyway, so in the expenses for March were 52,400. Well, we're going to add back 9 because those are not a cash need. So we really are left with 43,400. And it said in the problem, 70% is paid in the month that it was incurred, 30% in the following month. April's expenses, taking away the 9 grand, 70% in April, 30% then in May. May's expenses, 70% in May, 30% in June. So what this does for the CFO is says, okay, now we know how much we got for production cash needs. This is how much we need for selling and administrative and how we pay those bills. And we have to marry all of this information, our cash needs here, as well as our cash inflows here. Because ultimately, when I was a CFO at Hague Companies, we we were awesome at our cash budget needs. And you've got to be, because you got to know what you have in your cash account at all times. You hear the phrase again and again and again, cash is king, right? You cannot pay your employees with credit. So when I knew what our cash needs were for purchases, for whatever, and I knew when our estimated cash receipts were to be collected, but boy, I had to be spot on when it was time for payroll. And of course, everything up here too, all of these expenses, these are estimates. Now we control AP, no doubt. We control the cash payments. So if I've got payroll coming on Friday and I don't have enough in payroll, the payroll account, I would probably hold off in my accounts payable until Monday to make sure I had payroll covered. Or the best thing to do is get with your bank and get a line of credit so that you always have, that you have cash available for payroll. Employees are very unforgiving and need to be for payroll, okay? You know what? You guys did really good today. I noticed Hank did not fall asleep today. I watched that. So since Hank didn't fall asleep, so we will call it a day. You guys did well. So on Thursday, the last that we'll look at is exercise 21 and problem 2A. Does that sound right? Problem 2A. Where's my notes? Can't find. Yes, problem 2A. And what I'm going to also do is I will put I'll put this on Cengage, problem 3A as extra credit. Just another budget one. So that'll be out there for extra credits, not required. On that note, you guys all did extremely well on that test. I appreciate you doing as well as you did. So if any of you have any questions, now's the time. Hey, you guys have a great day. The weather's going to get better. And I'll always conclude it this way. If there's anything that you're having problems with, this whole online thing now is starting to get old, right? We've done this now for a few weeks and we're starting to see people are getting kind of burned out, tired, and that's to be expected. So if you need something, or if you need an extension, or just whatever, we don't know unless you reach out, so please do so. On that note, you guys have a great day, okay? And we will talk again soon. You too.